suddenly have an appetite for more boring investments. Kate Rooney has the story for us. Hi, Kate.
Hi, Tyler. So boring investing is making a comeback. Retail investors are rediscovering the philosophy made famous by Vanguard's founder, the late Jack Bogle. He preached low-cost, passive investments that compound over years. And fans have long called themselves Bogleheads. They're well-positioned right now for the current market, where timing has proved difficult. As Bob Pisani has pointed out, just 8 days have accounted for all of the S&P 500 gains, and higher rates have slammed growth stocks, which are widely held by retail investors. We spoke to one Boglehead who said he feels vindicated now after avoiding meme stocks and watching them surge from the sidelines.
I think, if anything, maybe it's a little bit of vindication for the tortoise and the hare, that I'm happy to be the boring investor. I'm happy to be the tortoise, because while the hare does win sometimes, the tortoise, more often than not, is going to come out ahead at the end of the day.
The Boglehead Group has a Reddit page as well, where they describe themselves and the strategy as lazy investing. Robinhood's founder and CEO Vlad Tenev also told me recently that he's seen more chatter about Robinhood in that Bogleheads Reddit group versus the famous Wall Street Bets group. Tenev also noted a mentality shift to longer-term investing and then flows into bond ETFs. Vanda Research also points out bond ETF BIL was the third most bought fund last week after the Qs and SPY. As they put it, income-seeking retail investors are now trying to take advantage of the high-rate regime, calling the strategy T-bill and chill. Back to you guys.
What do we know, if anything, Kate? I don't mean to put you on the spot, about flows into index funds, which, of course, were kind of a Bogle innovation and certainly part of his trademark.
So I don't have it in front of me, Tyler, but overall, passive investing, bond ETFs especially, money market funds are seeing an uptick. So we've seen this resurgence, and anything that's offering higher yield. So there's a lot of yield chasing going on, and it is really this new regime. There's a lot of retail investors that have gotten into the markets in the last 3 or so years, really during the pandemic when interest rates were zero. So they're trying to adjust and figure things out here. I think there's some longtime investors who might go with the old 60-40 rule. There's a lot of new investors who maybe bought, a meme stock, bought one of these high growth names, and now they're sort of maturing along with the markets and adjusting to this rate environment. But we're seeing that in bond ETFs and some of the higher yielding products, but ETFs in general and some of those low cost ways to get exposure are definitely ticking up here.
I guess the return of the 60-40 rule has been one of the sort of surprising things over the past year, I guess, right?
Yeah. Well, it is, again, some of these retail investors either moving their money into fixed income or even things like retirement accounts. It's been interesting to watch Robinhood at least try to sort of keep up with the changing appetite for retail investors and offering things like retirement accounts, which you talk about those as boring, but it's really things that people need to build long-term wealth here.
Thank you, Kate. Kate Rooney. Appreciate it.
Thanks, guys.